Welcome back to the channel. In this video, I'm going to walk you through a step-by-step, beginner-friendly roadmap to building real passive income through dividends. Even if you're starting from zero, we'll cover everything from choosing the right stocks and ETFs, to reinvesting your dividends, to creating a realistic timeline, and avoiding the biggest mistakes that new investors make. By the end of this video, you'll have a clear, practical plan you can start applying today to move closer to $1,000 per month in dividend income. Let's get started. What if I told you that you could build a system that pays you $1,000 every month, even while you sleep, and you don't need a lot of money to start? Most people think dividend investing is complicated, but today, I'm going to show you exactly how simple it really is. Start with the goal: $1,000 a month dividend income. If your goal is to earn $1,000 every month in passive dividend income, the first step is simple. Start with the end in mind. Before you buy a single stock, you need to understand exactly what this goal requires. Think of dividend investing like building a machine that slowly gets stronger over time. Every dollar you invest becomes a tiny worker that brings back cash for you month after month, year after year. And the more workers you have, the more money they bring back. So let's break it down. To earn $1,000 a month, you need $12,000 per year in dividends. Now ask yourself, how much money do I need invested to make that happen? It depends on something called the dividend yield, the percentage companies pay you every year for holding their stock. For example, if your average dividend yield is around 4%, you would need roughly $300,000 invested to reach $12,000 a year. If your yield is 5%, you'd need closer to $240,000. And with higher yield options around 6%, you'd need about $200,000. Now, don't let these numbers scare you. Nobody starts with hundreds of thousands of dollars. Most investors begin with small amounts, maybe $100 or $200 a month. What matters is consistency, because dividends grow, and when you reinvest them, your money starts compounding. 1. So your real job in this stage is to create a clear plan. How much can you invest every month? What yield are you targeting? And how long will it take you to reach the $1,000 a month milestone? Once this foundation is set, the rest becomes much easier. You'll know what to buy, how much to invest, and how fast you're moving toward your goal. Remember, every big dividend investor started exactly where you are, by setting a simple goal and taking the first step. 2. Understand dividend yield 3%, 4%, 5% example before you start investing for monthly dividend income. You must understand one simple but powerful concept. Dividend yield. Dividend yield tells you how much cash a company pays you every year, compared to the price of the stock. Think of it like interest, but from companies instead of banks. Here's how it works. If a company has a 3% dividend yield, that means for every $100 you invest, you earn $3 per year in dividends. With a 4% yield, you earn $4 per year for every $100. And with a 5% yield, you earn $5 per year. The higher the yield, the more income you get. But that doesn't automatically mean it is better or safer. Some companies offer high yields because their stock price has dropped, or their business is risky. Others offer lower yields because they are more stable and grow slowly over time. Let's look at real numbers. If your portfolio averages a 3% yield, you would need about $400,000 invested to earn $12,000 a year. That is your $1,000 monthly income. At a 4% yield, you need around $300,000 in 85%. You need roughly $240,000. This is why choosing the right yield range is important. Too low, and you'll need a huge portfolio. Too high, and you might be taking unnecessary risks. Most smart investors aim for a balanced range, somewhere between 3% and 5%, depending on their strategy, risk tolerance, and long-term goals. Once you understand dividend yield, you can plan your investments more confidently, calculate your future income, and make smarter decisions about which companies deserve your money. 3. Start small. You don't need big capital immediately. One of the biggest myths about dividend investing is that you need a lot of money to get started. But the truth is simple. You can start small, even with $20, $50, or $100 a month. Every successful investor begins exactly the same way, with their first small deposit. Think of dividend investing like planting a tree. You don't need a giant tree on day one. You just need a tiny seed. Over time, with consistent watering, it grows into something strong that gives you shade, fruit, and long-term benefits. Your dividend portfolio works the same way. Let's say you start with just $50 per month. At first, your dividends may only be a few cents. But here's the magic. Those cents grow into dollars, and those dollars turn into more dollars when you reinvest them. That's how compound growth works. Now imagine you slowly increase your monthly investment as your income rises. Maybe in a year, you move from $50 to $100, then to $150. These small increases can cut years off your journey toward $1,000 a month in passive income. What matters most isn't the amount you start with, it's your consistency. Because when you invest a fixed amount every month, you're building a habit. You're buying more shares when prices are low and fewer when prices are high. Over time, the strategy smooths out the ups and downs of the market. And something powerful happens. Your portfolio begins to grow faster than you expect. Your dividends become larger. They get reinvested. And suddenly, what started as a small monthly investment turns into a reliable stream of passive income. So don't wait until you have $10,000 or $100,000 saved. Start with whatever amount you can today. The earlier you begin, the faster your money can grow, and the sooner you can reach that $1,000 per month goal. 4. Pick stable dividend stocks. When you're building a dividend portfolio, one rule matters more than anything else. Choose stable, reliable dividend payers. You don't want companies that pay high dividends one year and cut them the next. You want consistency. That's why smart investors focus on two types of investments: stable dividend stocks and dividend-focused ETFs. Let's start with dividend stocks. These are companies with long histories of paying and often increasing their dividends. They're usually leaders in their industries, companies that people rely on every single day. Think utilities, telecom companies, consumer goods, banks, and energy firms. These aren't get-rich-quick stocks. They're steady performers that can survive recessions and still pay dividends. A good sign of stability is a company that has paid dividends for 10, 20, or even 30 years without interruptions. Some companies even raise their dividends every single year. These are called dividend aristocrats. They grow your income automatically. Now let's talk ETFs. Dividend ETFs are perfect for beginners because they give you instant diversification. Instead of picking individual stocks, you're buying a basket of proven dividend-paying companies. They lower your risk, smooth out market volatility, and still give you regular income. For many investors, dividend ETFs are the easiest way to start building passive cash flow. The biggest advantage: both stable stocks and ETFs help protect your income. You don't want surprises. You want predictable, long-term cash returns. So when you're choosing where to invest, don't chase the highest yield. Look for reliable companies, steady dividend histories, and ETFs built specifically for income. Because the goal is not just to build a portfolio, it's to build a dependable income stream that grows with you year after year. 5. Monthly versus quarterly dividend strategy. When you start building your dividend portfolio, one big question comes up early. Should you invest in monthly dividend payers or quarterly dividend payers? The truth is, both have advantages, and a smart investor uses a mix of each. Let's break it down simply. Monthly dividend stocks and ETFs pay you every single month, just like a salary. This is great if you want consistent cash flow you can depend on. It also feels more motivating because you literally see money coming into your account every 30 days. For beginners, monthly dividends make the process exciting and easier to track. But here's the catch. Many monthly payers offer slightly lower growth, and some are riskier, like REITs or high-yield funds. So you get money more often, but sometimes with higher risk. Now let's look at quarterly dividends. Most large, stable companies pay dividends every 3 months. This includes dividend aristocrats, blue-chip companies, and strong ETFs. These are usually safer, more reliably, and grow their dividends over time. Quarterly dividends may not feel as exciting, but they often come from higher quality companies, the kind you can hold for decades. So, which one is better? Here's the smart strategy. Use both. Monthly dividend payers give you frequent cash. Quarterly dividend payers give you stability and long-term growth. When you combine them, your income becomes smoother, more consistent, and more predictable. Many investors build what's called a dividend calendar, a mix of monthly and quarterly payers that ensures money is coming in every single month of the year. The goal isn't whether dividends arrive monthly or quarterly. The goal is building a portfolio that pays you $1,000 a month, reliably, for life. And the best way to do that is by using the strengths of both monthly and quarterly dividend strategies. 6. Reinvest dividends drip. If you want your dividend income to grow fast, there's one strategy you absolutely cannot ignore. Reinvesting your dividends, also known as DRIP, Dividend Reinvestment Plan. Here's why it's so powerful. When you first start investing, your dividends might feel small, a few cents, maybe a few dollars. But when you reinvest those dividends, they buy you more shares, and those extra shares start earning more dividends. Then those dividends buy you even more shares, and the cycle repeats. This is the magic of compound growth. Your money creates more money automatically. Think of DRIP like planting a tree, and every dividend payment is a new branch. As those branches grow, they start producing leaves of their own. Over time, your tree becomes bigger, stronger, and produces more and more income without you doing anything extra. Many brokers offer DRIP for free. The moment you receive a dividend, it gets reinvested into the same stock or ETF instantly. You don't have to think about timing, you don't have to place trades, and you don't have to worry about emotions. It's a fully automatic wealth-building system. Let's look at the impact. If you invest in a company with a 4% dividend yield, and it increases its dividend every year, reinvesting those dividends can double or even triple your long-term returns, compared to taking the cash and not reinvesting. DRIP turns your portfolio into a compounding machine. So if you're serious about reaching your goal of $1,000 a month in dividend income, reinvest every dollar you earn, especially in the beginning. Later, when your portfolio is large enough, you can turn DRIP off and start collecting the cash like a paycheck. But right now, reinvesting is the fastest way to grow. 7. Avoid high-risk, too-good-to-be-true yields. When you start dividend investing, you'll quickly notice something tempting. Some stocks offer huge dividend yields to 8%, 10%, even 15%. And you might think, wow, this will get me to $1,000 a month so much faster. But here's the truth. If a yield looks too good to be true, it uswaji. High yields often come with high risk. And many beginner investors learned this the hard way. A company might offer a 10% or a 12% yield not because it's generous, but because its stock price has crashed, its business is struggling, or its dividend is not sustainable. In money cases, these companies eventually cut their dividend, wiping out income and causing the stock price to fall even further. Imagine building your portfolio for months, only to wake up one morning and see your dividend slashed in half, or gone completely. This happens all the time with extremely high-yield stocks. That's why smart investors focus on the quality of the dividend, not just the size. Look for companies with strong cash flow, stable earnings, low payout ratio, a history of paying dividends consistently, and a business model that can survive tough times. A healthy, safe dividend yield is usually in the 3% to 5% range. It may not look as exciting, but it's far more reliable. And reliability is what builds long-term passive income. Remember, your goal isn't high yield. Your goal is dependable income. A stable 4% yield for 20 years is far better than a 12% yield that collapses next year. So when you see a dividend that looks unbelievably high, step back, do your research, and protect your portfolio. Because the fastest way to fail in dividend investing is chasing returns that look too good to be true. 8. Step by step. plan for beginners. If you're new to dividend investing, the process can feel confusing. But the truth is, getting started is much easier than it looks. All you need is a simple step-by-step plan to follow. So here's a beginner-friendly blueprint to help you build your future dividend income, even if you're starting from zero. Step 1. Set your goal. Know what you're aiming for. Like earning $1,000 a month. This gives you direction and keeps you motivated. Step 2. Learn the basics. Understand simple concepts like dividend yield, payout ratio, DRIP, and diversification. You don't need to become an expert. Just grasp the fundamentals. Step 3. Start small. Begin with whatever you can comfortably invest, $20, $50, or $100 a month. What matters most is building the habit, not the amount. Step 4. Choose safe dividend payers. Focus on stable companies and ETFs with a history of reliable dividends. Avoid risky stocks with unrealistically high yields. Step 5. Mix monthly and quarterly payers. Build a dividend calendar so you receive income every single month. Use monthly payers for cash flow and quarterly payers for long-term stability. Step 6. Reinvest automatically. Turn on DRIP. Let your dividends buy more shares, which earn even more dividends. This accelerates your growth without any effort from you. Step 7. Stay consistent. Invest every month, whether the market is up or down. Over time, consistency beats timing. Step 8. Track your progress. Watch your dividend income grow from cents to dollars to hundreds. Small wins keep you motivated and show that your strategy is working. Step 9. Be patient. Dividend investing is a long-term journey. Your portfolio won't explode overnight, but in a few years, you'll be shocked by how much it has grown. Following these steps, anyone, even a complete beginner, can build a steady, reliable passive income stream. This is the road to financial independence, and all it takes is the courage to start and the discipline to keep going. 9. Show realistic timeline. One of the most important things new investors need to understand is this. Dividend income takes time. It grows slowly at first, and then suddenly, it grows fast. But only if you stay consistent. So what does a realistic timeline look like for reaching $1,000 a month? Let's break it down. If you're investing $50 to $100 a month, the first year may feel slow. Your dividends might be only a few dollars. That's normal. This is the seed planting stage, where nothing seems to be happening on the surface, but growth is happening underneath. By year 2 to 3, things start to change. Your investments grow, your dividends get reinvested, and your monthly contributions begin to stack. You may start earning $10, $20, maybe even $40 a month in passive income. This is where most people quit, but this is also where compounding starts working harder for you. From year 4 to 6, your portfolio gets noticeably bigger. Your dividends could reach $100 plus per month, depending on your contributions and yield. You're no longer relying only on your deposits. Now your dividends are creating more dividends. And be year 7 to 10. Something amazing happens. Your growth accelerates. Every reinvested dividend is buying more shares, which generate even more income. This is where serious investors start hitting $300, $500, and eventually $1,000 plus per month. The exact timeline depends on how much you invest monthly, your average dividend yield, whether you reinvest dividends, market growth. But here's the truth. No one becomes financially free in a year. But almost everyone who stays consistent for 5 to 10 years wins. If you stay disciplined, keep investing regularly, reinvest your dividends, and avoid risky high-yield traps, reaching $1,000 a month is not just possible. It's predictable. This journey rewards patience, not perfection. You don't need speed. You need consistency. 10. Encourage long-term mindset. If there's one thing that separates successful dividend investors from everyone else, it's not money. It's mindset. Dividend investing is not about getting rich overnight. It's about building wealth slowly, consistently, and safely over time. Think of this journey like building a house. You don't lay one brick and expect a mansion. You lay brick after brick, day after day. until one day you step back and realize you built something strong, stable, and valuable. Your dividend portfolio works the same way. A long-term mindset means understanding that dividends grow slowly at first. Compounding takes time. Markets go up and down, but consistency always wins in the end. Every great investor has gone through moments of doubt, market crashes, and slow periods, but they stayed focused on the long-term goal. And because of that, their portfolios grew into something powerful, something that pays them month after month, year after year. When you stay committed for the long run, something incredible happens. Your early investments start working harder than you do. Your dividends begin to grow on their own. Your portfolio becomes a passive income engine. This is why patience is your biggest superpower. Don't get discouraged when progress feels slow. Don't compare yourself to others, and don't chase risky shortcuts or impossible returns. Trust the process. Let compounding do its work, because 5 years from now, 10 years from now, you'll look back and thank yourself for every small investment you made today. Remember, you're not just investing money, you're investing in your future freedom. Stay disciplined, stay patient, and stay focused on the long-term vision. That's how you build real, lasting wealth through dividends. And that's it. You now have a complete roadmap to start building your dividend income from zero all the way to $1,000 a month. Remember, you don't need a lot of money. You don't need perfect timing, and you definitely don't need to be a financial expert. All you need is a plan and the discipline to stick with it. If this video helped you understand dividend investing more clearly, make sure to like the video, subscribe, and turn on notifications, because I'll be sharing more simple, beginner-friendly guides just like this. And if you want me to create a full step-by-step action plan based on your personal budget or goals, drop a comment below. I reply to everyone. Thank you for watching. Stay consistent, stay patient, and I'll see you in the next video. Your dividend journey has just begun.